Welcome back, everyone. Michael here with Offshore Citizen. Today I'm going to cover international tax planning for Canadians, or how Canadians can pay the lowest legal amount of tax possible by setting up international structures and optimizing themselves to, just save a ton of money. So save a ton of money on tax using international structures as a Canadian. That's what we're going to talk about today. So if you haven't already, please hit the subscribe button, hit the notification bell. We really appreciate all your support. If you like the video, please share it with your friends. Please give it a thumbs up. If you don't like it, please tell us in the comments. And if you're at all interested in help with how to set up international structuring, how to pay the lowest legal amount of tax possible, regardless of where you lived, regardless of where you want to live, if you're interested in moving abroad and taking advantage of some of those benefits, you're interested in what residency programs, where you should go, etc., please reach out to me. If you're interested in second citizenships, including unofficial citizenship by investment programs, etc., please reach out to me. You can book a call below, clarity.fm/Michael Rosmer. There's a link in the description. Or you can check out our websites, offshorecitizen.net and offshorecapitalist.com, and send us a message through there. Okay, so I just finished this week doing a review, some analysis for a client, basically showing them they were a Canadian-based company, fairly successful, etc. And they were they were running everything through Canada, in spite of the fact that a bunch of the partners, as well as a bunch of the operations, etc., were outside of Canada. Okay, and this is not very optimal. So they kind of had some misunderstandings about how the tax system in Canada works and how this could benefit them. So I'm going to go through. I'm going to be a little bit technical in terms of some of the terms here. And I'm going to try and give you kind of a basic idea of how it ends up. I'm going to assume kind of the highest marginal tax rates, even though you might be in a situation where you have lower tax rates. I'm going to talk about what it is, the level that makes sense for you to start doing this. And we'll dive into that. So to start off with, it's worth noting that Canada has a small business tax rate, which is not too unreasonable. The federal rate is 9%. Then you have a provincial rate. The provincial rate typically will be like 2.5%. It varies by province, but let's say 2-3%, something like that. So you end up paying 11 to 12% in most provinces. That's up to 500,000 Canadian dollars. Now it's Canadian dollars, so it's a little bit less than some places, but hey, that's the way that it goes. So, and that's profit per year. So generally speaking, if you're under 500,000 Canadian dollars a year, then it doesn't really make that much sense for you to go and to do an international structure. Simply because, just run the math, right? 500,000 multiplied by 12, you're talking about $60,000. Let's say that it costs you, $30,000 to set up a structure, and another $20,000 a year to maintain it, okay, you're getting an ROI if you can shift all your income there. You probably can't shift all it there. It's probably going to be a mix. And in the process, you're raising a bunch of other complications. So usually what I tell people is once you cross that small business threshold, it starts to make a lot of sense. And the reason for this is, if we look at, say, in Ontario, usually the real tax rate that is payable is about 26.5% corporate tax. Now, in certain cases, it's higher because there's a federal abatement and there's a bunch of different complicated things that I'm not going to get into, because they start with a 38% tax rate and then they start pulling some things off. Anyway. Bottom line is that's usually the level that it starts to make sense. And here it's really important to understand that Canada actually has some of the most favorable international tax laws out of a developed country. So domestically, taxes aren't so great, but internationally, they're pretty good. And the reason for this is it's fairly easy to have an international company, have the company make money, potentially at zero tax, and then bring it back to Canada tax-free, okay? So let's talk about how that works. So in these situations, you would of course need some sort of operations outside of Canada, okay? That's the first thing. You're definitely going to need some sort of substance. If everything is in Canada, this is not going to work for you, okay? Let's assume that some things are not just in Canada. So you say, okay, great. The first thing that you're going to need is that international whatever, which is easy for a lot of online businesses, right? You're using contractors in the Philippines, you're using people around the world, Latin America, Eastern Europe, whatever. Like a lot of your team, a lot of the real work that's happening in your company could be taking place outside of Canada. And if that's the case, it does not make a lot of sense to run things through Canada. On top of that, increasingly, it's not going to make that much sense to employ people in Canada because, as we know, wages on a relative basis, not so favorable. And you're in a situation where, look, the truth is these things are, Canada's more likely to raise costs. These other places are going to be more competitive in terms of socials and all these other things. So anyway, that's a whole other conversation, but it makes sense. Like you can have a genuine business purpose of setting up operations internationally, and you will save money totally irrespective of tax. And then you can, on top of that, save a ton of tax, okay? So what you do is you start by forming a company internationally. Now, there's a couple of different pieces here that are important. Obviously, you want to have lower than the Canadian tax rate. That's important. In order to take advantage of a set of rules that we're going to talk about in a second, called the exempt surplus rules, you need to have a company in a jurisdiction where Canada has a tax treaty. This can be a double tax agreement or a tax information exchange agreement. Historically, people used to use Barbados all the time. The reason for that was because of the fact that until 2012, I think it was, you couldn't use a country that had a tax information exchange agreement, and most of the zero tax countries didn't have a double tax agreement, so that was something, okay? So there's some science that goes into figuring out where you should set up that company based on the costs that are going to be associated there, based on the tax rates, based on the financial services, the infrastructure, etc. Right? But bottom line, actually I have another video on some of the best places to form offshore companies for Canadians. So bottom line is you're going to have something outside the country. Now next, you have to realize under Canadian tax rules, management and control, not just place of registration, is the typical way that they will determine where it is taxable. So as a result, you can't be in a situation where you say, oh great, I have a company that is in Isle of Man, but I run it from Canada. Okay, that doesn't work. Then it's a Canadian company, you gain no benefit. Same thing, this Belize company, this Seychelles company, etc. So you need to say, okay, one of two things need to be true. Either, hey, genuinely there's management and control abroad, which is a reasonable way to go. That's what we like to set up. Or we're in a situation where we say there's a tax treaty that overrides this. So for instance, you could do that in Estonia, you could do that in Bulgaria, the US can do that. It's a whole other conversation about the US, but anyway, these are all options, okay? Point is, the company has to be genuinely foreign. Then what happens? That company makes money. Surprise, surprise, right? Now, if you have operations in Canada, you're gonna have to split it, right? You're gonna have to find some way of saying, hey, listen, X portion of the income is attributable to Canada, we're gonna pay full corporate tax in Canada, X is attributable to the foreign company, we're gonna pay the foreign tax abroad. That foreign company now should be owned by a Canadian company, okay? So the Canadian company owns the foreign company, all right? Maybe you have it where the foreign company is hiring the Canadian company, maybe the Canadian company is taking the Canadian form of the sales. We have to figure out case by case what makes sense for your company in order to save this money, okay? However, you do that, great. What's next? So you've got the international company, it's owned by the domestic company. The international company is in a jurisdiction that has a tax treaty with Canada, that's awesome. You have international substance, fantastic. International management and control, fantastic. Ideally you have, let's call it zero tax, okay? Now, so long as there's active business income, okay, this company can pay dividends to the parent company in Canada tax-free, okay? So that becomes tax-free income for the Canadian company, okay? So that's pretty good, right? Now, what happens here? Well, there's a couple different things that could happen here. You might own the company in Canada entirely, and that's great. You're in an optimized situation. You're feeling happy about yourself. You're paying less tax. We like that. But you don't have the money personally. Is that a problem? Not necessarily. Because for instance, if you want to qualify for a mortgage, you don't necessarily have to. Normally you end up in this situation where you say, hey, listen, I'm trying to lower my taxes by showing lower income at the corporate level, but that's bad for qualifying for mortgages, right? Or I say, hey, I'm trying to raise my income, right? Which is good for mortgages, but it's bad for taxes, right? So you're playing this teeter-totter balance, which is really unfortunate. In this way, you can play the best of both worlds. You can show the full income of the company. You can be like, hey, look, we have $2 million in income, and you can use that to qualify for mortgages, and that can be really efficient, right? So that's good. However, if you actually, so let's just kind of do a comparison here, because with this client, we're kind of comparing to show them what was the deal. So normally, what happens in Canada, let's say you have a Canadian company, let's just say that it pays the 26% tax. We're going to ignore any small business tax or any of that sort of stuff. So 26%, then what will happen is it will pay out a dividend to the shareholders, okay? The way that it works in Canada is you can have eligible or ineligible dividends. If you have eligible dividends, which would be normally what would happen, you do something called a gross up. You would gross it up by 38%, okay? Then you get a tax credit based on the federally of 15.0198%. That's for this year anyway, when we're filming it. of whatever the grossed up amount is, and you get to reduce that from the taxes that you're going to pay. Okay. At the same time, provincially, you do the same gross up, but you get a different percentage. And so you're going to have your federal taxes and your provincial taxes. Okay, so you're going to say, okay, great, I'm at my federal and provincial taxes. Wonderful. Normally, let's say this would be 46%. Okay, 46% would be like, if you're in the highest tax bracket, about where you would end up being on a fairly high income. Okay, so you're like, okay, I'm going to pay 46% blended tax rate. Because of the fact that you've paid the corporate tax, right? This gross up on the income is allowing, so basically, okay, so you say, my income is $1 million. I gross it up by 1.38, so I'm gonna be at 1,380,000. I'm gonna then multiply that by, let's say, the 15% federally, and let's just say it was Ontario, so it was 10% provincially. So that becomes a tax credit against the taxes that I'm gonna pay. Normally I would pay, let's say, the 46% or whatever on this, and so I'm deducting. Basically what I'm doing is it's canceling out the tax that was already paid at the federal level. It doesn't do it 100%, so you usually end up with slightly higher. So instead of, say, 46%, you end up paying 47 or 48%, but it's fairly accurate, okay? Now, in this case though, it's quite a bit better because you would ignore the federal tax, right? So you don't have the 26%, at least on the portion which is abroad, right? Which could be a substantial portion. So that money comes in tax-free. You still get the gross up. So basically you get this 38% gross up for eligible dividends in something called the general rate income pool. Okay, so certain types of income doesn't qualify for the general income pool, and then you get what's called ineligible dividends, and that's a whole other conversation. It's basically a lower gross up and a lower tax credit. But exempt surplus qualifies. It's what's called Schedule 113, and so that gets included in your general rate income pool, which is fantastic. Right? As a result, you can compress this down. You can pay, much less, and your effective tax rate, if you're in the highest tax bracket, it becomes about 28%. So is 28% a good tax rate? No, 28% is a terrible tax rate, right? It's really not good. But on the other hand, if you compare it to 48%, you just save 20% on your income. So imagine, instead of, on $1 million a year, we're just going to take that as a random number. In theory, you'd have a blended rate, so it's probably not quite that much. But let's just say you're talking about that's 200 grand in tax savings per year, right? What can you do with $200,000 a year? This is like enough to buy a small house. So, every single year, and as your income grows, that's going to increase over and over again, right? This is without doing fancy tricks to get money out of the company. This is like very straightforward tax planning, okay? So anyway, this is something that I highly recommend for Canadians, is to find some ways to do international structuring like this. Again, the nuances matter, right? What country are you setting up in? Where are your operations? How do you make sure that the management and control is genuinely foreign, that the residency of the company is not going to be questioned by CRA? Make sure that if there's any transfer pricing, that's handled properly, that permanent establishments in Canada are accounted for. All of this kind of stuff, right? You're going to figure all that stuff out. But when you do, you can really optimize this very effectively to be in a very, very efficient tax position. So anyway, I hope that helps. That gives you a basic idea of how it works and what it is you can save. You can, of course, defer at the corporate level and potentially not pay. You can actually defer at the international level, and you could get all kinds of extra write-offs that you couldn't get normally in Canada. You can do that as well. So you can get, I would say that you should be able to reduce your taxes by probably 50% at least if you structure it properly. And so, run the math, go and say, hey, what am I paying in tax? Does it make sense for me? If it does, great, have a conversation. I hope you enjoyed that. If you have questions, put them in the comments below. If you liked the video, give it a thumbs up, share it with your friends, and I will look forward to seeing you guys. Hopefully, you'll visit and reach out and book a call with us. We can talk about how to optimize your situation, but otherwise, I'm gonna see you guys on the next video.